U.S. monetary system, the quick and easy version, part 2, brought to you by rebelcapitalist.com. Like we warned in part 1, this is not a college lecture or a high school lesson. We do hope that you learn at least one thing from this presentation. Okay, let's do this real quick. What are we going to cover in part 2? First, we're going to talk about the Federal Reserve System. Second, we're going to touch upon U.S. monetary policy. And probably most importantly, third, particularly as this relates to our daily lives, is what is the impact of monetary policy on our economy? Now let's turn our attention to the Federal Reserve System, also known as the Fed, and outside the U.S. it's known as the U.S. Central Bank. It was created in 1913 by the Federal Reserve Act. Now there are 12 regional banks. I'm not going to name them all, but there are regional banks in Chicago, New York, and interestingly, 2 in Missouri covering different regions, of course, one in St. Louis and one in Kansas City. The Fed is governed by a Board of Governors, which has 7 members, plus a vice chairman and a chairman. They're all appointed by the president and confirmed by the Senate. Now, the Fed is considered an independent governmental agency because its decisions are not ratified or approved by the president. But on paper, and I stress on paper, via federal law, Congress does have oversight authority. The Fed has 4 main responsibilities. One is to determine and implement U.S. monetary policy, as we're discussing here, regulate banking institutions, maintain the stability of the U.S. financial system, and provide financial services to banks, the U.S. government, and foreign official institutions. Today, we're hearing a lot about the Fed pumping in $70 billion into financial system. They have recently bailed out Bear Stearns. They do this pursuant to the responsibility of maintaining the stability of the U.S. financial system. The major component of the Fed is the Federal Open Market Committee, or the FOMC. The FOMC oversees the main tool used by the Fed to influence interest rates and credit conditions, or overall monetary policy. The Federal Reserve Act states that the Fed, particularly FOMC, should promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. So, and this is law. This is in the Federal Reserve Act. They are tasked with maintaining a good economy. U.S. monetary policy is any action taken by the Fed to influence the availability and cost of money and credit to help promote national economic goals. Now, the bottom line is this. I mean, the Fed will do what it can to influence interest rates, and which will then have an impact on our economy. That's the bottom line. That's what they're there for. Now, how do they do it? What is their big tool? Well, here, let me start with explaining that the depository institutions such as banks have these accounts at the Fed. They're called required reserve balances, contractual clearing balances, and excess reserve balances. These depository institutions trade these account balances with each other, usually overnight, and the rate that they charge is called the Fed funds rate. And that's very important. That's their key tool, the FOMC's key tool, Fed funds rate. For instance, Bank A would have a surplus in one of their reserve accounts, and Bank B may be anticipating, because they're having a big deal closing, or they're having a big withdrawal because some company might be taking money out, And so they need cash overnight to meet these obligations. These banks would trade their reserve accounts overnight, and Bank A would charge Bank B the Fed funds rate for this trade. Let's talk about the implementation of the monetary policy. Well, the Fed affects the conditions in the market for those balances that we talked about that these institutions hold at the Fed. Now, and they hold incredible amount of control over the Fed funds rate through the influence over the supply and demand for these reserve balances. Now, I know this seems kind of convoluted, but the FOMC basically sets a target for that Fed funds rate that we're talking about in order to foster certain economic conditions. Now, this is how it works. If the Fed believes that inflation is too high or the economy is heating up, then the FOMC will set a higher targeted Fed funds rate. And the opposite is true. If the Fed believes that the economy is slowing down, that we're heading into a recession, then the FOMC will set a lower targeted Fed funds rate. So what does all this mean on the economy? Well, a change or even an expected change in the Fed funds rate by the Fed will affect short-term interest rates such as Treasury bills and commercial paper, long-term interest rates such as fixed-rate mortgages, auto and consumer loans, foreign exchange value of the dollar, and stock prices. I mean, think about it. How many times have you heard in the news that the stock market either went up or down based on what the Fed did with the Fed funds rate? So how does this impact us? Well, in theory, because it doesn't always work this way, it doesn't have, for the Fed, it doesn't always have the intended effects. If the Fed believes that our economy is slowing or heading into a recession, obviously, like we talked about, it will cut the Fed funds rate. The effect of that would be that would stimulate the economy because businesses and people would have more money to spend on things and less on interest costs. One of the challenges that the Fed faces when they cut interest rates is that the value of the US dollar decreases. This means that imported goods such as oil and many of our products that we purchase from China cost us more money. Now, I have a question that I pose to economists out there, and that is the positive impact from a cut in the Fed funds rate offset by the increase in prices for imported goods such as oil, cars, clothes, and electronics? So generally speaking, now this goes to the U.S. dollar, the value of the U.S. dollar. Imported goods such as oil cost more, but exported goods are cheaper for foreigners to buy. Such as right now, China is buying a lot of heavy equipment from Caterpillar, and it's partly due to the weak U.S. dollar. A strong U.S. dollar obviously has the opposite effect. Imported goods cost less, such as the things that we buy at discounted retail chains, but the exported goods cost more. And I say that generally speaking because there are so many other factors out there in our economy that affect these things. So generally speaking, this is what happens with a weak or a strong dollar. Wow. That concludes part 2 of our presentation on the U.S. monetary system. Thank you for your attention. We do hope you learned something from part 1 and part 2. We hope to see you at rebelcapitalist.com. Good day and good luck.